The Fed just cut rates for the first time in over a year. Everybody's talking about housing in general, but not enough people are breaking down what it means for build to rent. And that's where we live every day. I oversee thousands of doors across multiple states, and I can tell you this rate cut touches everything: buying deals, rents, financing, even tenant strengths. So here's what we're going to do. I'm going to give you 6 impacts from this decision. And even if BTR is not your main focus yet, this applies to everyone investing in real estate. So let's dive in to number 1, more build to rent deals. Cheaper money makes more deals pencil. A quarter point doesn't sound like much until you're carrying an 8-figure loan. Then it's real dollars. You'll see sideline investors re-enter the market. Competition will start to heat up for both land and stabilize BTR assets. And with financing costs easing, cap rates start to compress. So here's the takeaway. There's a very short window right now where you can still buy at yesterday's pricing with today's cheaper debt. Let's dive right into number 2, rental pricing. This is really key. Yes, lower rates make buying a home slightly easier. Mortgage rates have already slid into the mid-6s, and some forecasters think high 5s could be possible if cuts continue, which there are indicators that they are going to continue. But here's the reality. Owning still costs roughly twice as much as renting in most markets. So only a small slice of renters will actually convert into buyers. Meanwhile, BTR rent growth has stayed positive, even with a wave of new supply. And it's expected to modestly accelerate. Now, here's the takeaway. A few renters will peel off and buy, but the core demand for rental homes isn't going anywhere. The high cost of housing is still going to be there, and it's still going to outpace the ability for renters to turn into home buyers. Let's go on to number 3, jobs and tenants. The Fed cuts rates to keep the labor market from weakening further. That's their goal. Now, August payrolls were soft. Unemployment ticked up to around 4.3%. So this cut is about protecting jobs. And for us, jobs are everything. Stable jobs mean stable rent checks. Developers keep building. Tenants keep paying. In our core growth markets, the Sun Belt and the Southeast, we're still seeing strong job creation. Now, here's the takeaway. The Fed is basically saying we're not going to let the labor market slide. And that stability flows straight in to occupancy and collections. So let's get into number 4 here. Inflation is trending closer to target. And with rates drifting lower, we're set for cap rate compression. Even 25 to 50 basis points of compression can add millions of value to large BTR projects. This is why you'll see stronger bidding return to quality assets. This is what we've been waiting for. Because the cost of capital falls, valuations rise. So here's the takeaway. If you own or you're building BTR right now, your exit values just got a tailwind. Let's talk about number 5, funding new projects. So let's talk about those who are still in the build stage. Construction loans, usually floating on the SOFR or the prime. The benefit? They'll benefit right away. Banks trim their prime rates after the Fed move. Permanent debt is easing too. And the 30-year mortgage rates are down in the 6.3, 6.5% range. That opens the door to refinancing. More projects start penciling. And lenders get a little bit more comfortable. This is what we've been waiting for. Here's the takeaway. A quarter point matters more than people think. Every basis point you don't pay on construction carry or your takeout loan is real breathing room for operations and things to move. So I want to get into our 6th and final impact. It's the private money in BTR. Now let's look at the equity side. A lot of capital has been sitting on the sidelines waiting for that green light. And the Fed's pivot is that signal. Smart money is already moving or is getting prepared to be deployed. Now, think about this. Berkshire and Hathaway revealed an $800 million position in Lennar. That's not a small bet. It's conviction in the U.S. housing. This is a sentiment shift from fear to optimism. Now, here's the takeaway. You better expect more competition for deals. It's coming. Are you ready for this? But also, more capital available for quality BTR projects and the big players putting their money into those builders for these types of projects. Have your underwriting tight and your story clear and be prepared to make those entrances into the market. So in closing here, let's do a quick recap. Rate cuts help deals pencil. More rate cuts, they pencil even better. Rental demand stays durable. Jobs are the hinge, and the Fed is protecting them. Values get a tailwind from cap rate compression. Financing just got improved, and capital is flowing back into housing. Everyone that's on the sidelines have been waiting, and here we go. We're starting to see that movement. So if you're developing or buying or just exploring build to rent, now's that time. Get proactive. Look for deals. They're coming, but we have a short window. Deals are shifting quickly. I want you to drop your comments down below. What are you chasing? What's your strategy after the Fed move? And as the Fed continues to move those rates. And if you want a deeper look at how we're operating in this current market, I've put together a case study at corybonner.com/case study. You'll find out more about how we're operating